Hi everyone, my name is Robin Speziale and I am the national best-selling author of a book called Market Masters. So in this video, I'm going to be talking about something that's called optionality, and it's a really interesting concept in investing in stocks. And I first learned about optionality actually when I interviewed all these amazing hedge fund managers for my book Market Masters. It was one hedge fund manager, his name Martin Brawn, who runs the Adelaide Trust here in Toronto, who talked about optionality. And Martin Brawn predominantly invests in microcap and small cap companies on the TSX. And he was telling me that, hey, Robin, if you're looking at investing in large cap companies, most of these big companies, like Loblaw, like Bell, like Facebook, like Apple, like Google, they have everything already for the most part priced in to their stock price. So, news and everything, they have a nice trend line already. They've, they're increasing their revenue year over year, net income year over year. They have many analysts following and reporting on these large cap companies. So because they're so closely followed, a lot of this information is already baked into the price of a stock. And so, you can't find many mispriced opportunities. If you buy, for example, Rogers Communications today, you might generate a return on the market of, let's say, maybe 5% plus perhaps a 5% dividend yield with a total return of 10%. And for the most part, everything is already baked in again, and Rogers will just grow in that trend line unless anything, systemic happens, anything really, really bad to the business. But the reason why he focuses on these smaller companies is because of optionality. And he says that, hey, look for the smaller companies, Robin, that don't have all this information priced in, because these smaller companies don't have a trend. They don't have many institutions, supplying capital and liquidity to the stock. There's not many analysts or no analysts at all covering some of these smaller companies. And therefore, you can utilize this optionality to your advantage, meaning that let's say you pick company A, it's underfollowed, not many institutions at all own it. It might be a $100 million market capitalization stock, and because it's not very well researched, because there's no given future for the company, you can come up with your own factors if you do your own research as to what might happen in the future. And optionality and probability go hand in hand here, where company A research all the different factors that could lead to an upside in the stock price. And so the more factors, the more options that can lead to an upside in the stock price, the better. So the more optionality in a small cap or micro cap stock that's underfollowed, because this information you would assume isn't already priced into the stock. If it ever were to happen, if any of these, let's say 5 or 6 or 7 factors were to happen, like for example, they acquire a couple of smaller companies in the year and their revenues triple or quadruple, or if perhaps they're able to patent a new technology, or if one of their new products is a breakthrough, or there's a regulation that passes as very favorable for their industry, or perhaps they land a very big account, a very big client from one of the S&P 500 companies. If any of these play out, and again, you have to use probability, that framework, then you can see more upside in the price of the stock. And I used the concept of optionality later after I met with Martin Brawn when I invested in Tweed, which then became Canopy Growth. And when I bought into Tweed in 2015, there weren't many analysts, at all covering the stock. I don't think many institutions were buying the stock, but you can see them buying it now. It's close to a $10 billion company. But I just listed all the different factors that could lead to an upside in Tweed stock. And there was, legalization actually happening. And, that would be on the back of Justin Trudeau and the Liberal Party actually getting voted in, which occurred a month later. And there's also the optionality of, what happens if Canopy Growth becomes a leader in the industry. What if? And it seemed that Canopy had the most optionality in the stock, but hadn't been baked in yet into the price of the stock. So people weren't projecting the future yet in the current price. And that's why I was able to buy in at right around $1 per share, and rode that wave once all these amazing options, these factors were priced in to Tweed. It went from $1 to close to $40 per share, a 40 bagger. And so this is a very interesting framework to think about, especially if you're going to be investing in these micro cap and small cap stocks. Again, it doesn't work. This optionality concept doesn't work when you're investing in a large company like a Facebook or a General Electric or any of these other bigger companies, because for the most part, a lot of the information has already been baked in and you don't really have much optionality in these larger companies. All right, guys, thanks for listening. Hope this helps. If you have any more questions, you can ask me through email, r.speziale@gmail.com, or you can check out my website for more writings on investing, which is robinspeziale.com. Thanks, guys.